VIP John AG here. $2 billion. That's not a typo. That's not speculation. That's the documented profit that a handful of players extracted from silver's crash this month, while retail investors watched their portfolios bleed red. And I'm about to name names, show you the exact mechanics, and follow the money trail that mainstream financial media refuses to touch. Because here's the thing. When silver drops over 15% in a matter of days, someone's losing. But someone's also winning. And those winners aren't you. They're not the small stackers. They're not the miners. They're the same institutions that have been running this game for decades. Stay with me for the next 15 minutes because what I'm about to reveal changes how you understand every single price movement in this market. Let me set the stage with where we are right now. Silver closed yesterday around $30.75 on the COMEX. That's down from the highs we saw earlier this month when we touched $34.50. Gold is sitting at $3,212 per ounce, holding relatively stable compared to silver's violent move. The gold-to-silver ratio has blown out to over 104. Let me say that again. 104. That means it takes 104 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60. When it spikes like this, it tells you silver has been disproportionately attacked. Now let's talk about what triggered this crash. On May 7th and 8th, we saw consecutive margin hikes on COMEX silver futures. The CME group raised initial margins on silver contracts by over 16% in a 48-hour window. This wasn't random. This wasn't routine maintenance. This was surgical. These margin increases hit right as silver was building momentum above $33, right as open interest was surging, right as the shorts were getting squeezed. Connect the dots. The Shanghai Futures Exchange silver price is currently sitting at a premium of about 3% over COMEX. That premium was over 8% just 2 weeks ago before the crash. What does that tell you? It tells you that Chinese buyers were paying significantly more for physical silver than the paper price suggested. It tells you the paper price was artificially suppressed even before this latest smash. And it tells you that the convergence we're seeing now came from crashing the Western paper price, not from increasing supply in the East. COMEX registered inventory dropped to 137 million ounces last week. That's down from 152 million ounces at the start of the year. We're seeing consistent drain despite the price falling. Eligible inventory sits at around 168 million ounces. Total COMEX silver inventory is now under 310 million ounces. That sounds like a lot until you realize that represents less than a third of annual industrial demand. One good supply shock and this whole paper edifice comes crashing down. Delivery notices for the May contract have been active. We've seen over 15 million ounces standing for delivery so far this month. That's not record-breaking, but it's consistent pressure on a system that relies on most contracts being rolled over, not settled in metal. Every ounce that walks out the COMEX door is an ounce that can't be used to suppress prices later. Here's what's happening in the broader macro environment. The Federal Reserve is stuck between inflation that won't die and an economy that's showing cracks. Core PCE came in at 2.8% year over year. That's still well above their 2% target. But job openings are declining. Manufacturing PMI is contracting. Consumer credit delinquencies are rising. The Fed held rates steady at 5.25% to 5.5%, and Jerome Powell's language has shifted from hawkish to confused. They don't know what to do. And when the Fed doesn't know what to do, precious metals should be rallying. So why aren't they? The dollar index has been relatively stable around 104, which normally would be a headwind for metals. But gold has held above 3,200 despite that. Silver is the one that got crushed. Why? Because silver is the manipulated market. Silver is where the big banks have concentrated short positions. Silver is where the leverage exists to engineer these kinds of moves. Now let's talk about who specifically profited from this crash. Looking at the numbers, about 75% of you watching aren't subscribed. If this unfiltered analysis is cutting through the noise and giving you clarity, hit subscribe. That's how we grow a community built on truth, not hype. Drop VIP John AG in the comments. If it's not for you, no hard feelings. I don't chase empty metrics. let's get back to it. Here's what makes this truly insane. The Commitment of Traders report from May 13th shows that the 4 largest traders on COMEX hold a combined net short position of over 340 million ounces of silver, 340 million ounces held by just 4 entities. That's more than the entire registered inventory. That's more than 1/3 of annual global mine production. And when you're short 340 million ounces and the price drops $3, you just made over $1 billion on that position alone. Factor in leverage, factor in options, factor in the derivatives that layer on top, and $2 billion in profits is actually conservative. Now, who are these 4 traders? The CFTC doesn't name them in public reports, but we know from historical data and bank participation reports that the usual suspects are the bullion banks. JP Morgan has been the dominant player in the silver market for years. Bank of America has significant exposure. HSBC and a rotating cast of other major banks round out the group. These aren't hedge funds speculating. These are market makers with access to central bank credit lines, with regulatory capture, with the ability to move markets because they are the market. And here's the smoking gun. The margin hikes that triggered the liquidation cascade didn't come from nowhere. CME Group's Risk Management Committee includes representatives from these same banks. Let me say that again. The banks that profit from silver crashing have seats on the committee that decides when to raise margins. They see the positioning. They know where the stop losses are clustered. They know exactly how much margin pressure it takes to trigger forced liquidations. This isn't conspiracy theory. This is documented market structure. The bank participation report from early May showed that U.S. banks increased their net short silver position in the week before the crash. They weren't reducing risk. They were adding to shorts right before they helped trigger the margin hikes that would make those shorts profitable. If a retail trader did this, it would be called front-running. When banks do it, it's called providing liquidity. Ted Butler has been documenting this for 30 years. He's filed complaints with the CFTC that go unanswered. He's shown mathematically that the concentration of short positions in silver is unlike any other commodity market. No other market would tolerate 4 traders controlling more than 100% of annual production on the short side. But silver does, because silver is the market they need to control. Why silver? Because silver is both a monetary metal and an industrial metal. Because silver's market cap is small enough to manipulate. Because if silver broke free and went to $100 an ounce, it would call into question the entire paper currency system. Gold gets attention. Silver gets suppressed. That's the game. Now here's the part they don't want you to see. While the paper price was crashing, physical demand was surging. Dealers across the United States reported spikes in buying as prices dropped. JM Bullion, APMEX, SD Bullion all saw increased order volumes. Premiums on physical silver actually held steady or increased during the paper price crash. American Silver Eagles are still selling for $3 to $4 over spot minimum. Generic rounds are carrying premiums of $2 or more. If there was no supply constraint, those premiums would collapse with the spot price. They didn't. The U.S. Mint has been rationing Silver Eagle sales all year. They cite supply chain issues and blank availability, but the real issue is that retail demand has been so consistent that they can't keep up. India imported over 8,000 tons of silver in the first 4 months of this year. That's a record pace. Chinese solar panel manufacturers are consuming silver at unprecedented rates, with over 200 million ounces going into photovoltaic cells annually now. The Shanghai Gold Exchange reported that silver withdrawals from its vaults exceeded 500 tons in April alone. That's physical metal leaving the exchange and going into industrial and investment channels. The paper price says silver is cheap. The physical market says silver is scarce. Which one do you believe? Mining supply is not keeping up. Global silver mine production has been flat to declining for years. We produced around 820 million ounces last year, but demand exceeded 1.2 billion ounces. That's a deficit of nearly 400 million ounces that had to be filled by recycling and above-ground inventory drawdowns. You cannot run deficits of that magnitude indefinitely. The math doesn't work. Let me address the bearish case head-on because balance matters. The OGs know I don't sugarcoat. The bears have legitimate arguments that you need to understand. First, margin hikes can continue. If silver rallies again, they can hike margins again. We've seen this playbook before. In 2011, they raised margins 5 times in 9 days. They can do it again. This suppression mechanism isn't going away. Second, there's over $600 trillion in global derivatives. If we get a deflationary shock, a credit freeze, a Lehman-style event, everything gets sold, silver included. Paper silver positions get liquidated regardless of physical fundamentals. In a liquidity crisis, correlations go to 1. Everything sells. Third, industrial demand is tied to economic activity. If the global economy enters recession, solar installations slow down, EV production stalls, electronics demand drops. Silver's industrial consumption could decline meaningfully. That's real demand destruction, not paper games. Fourth, the concentrated shorts have deep pockets. JP Morgan has access to Federal Reserve credit lines. They can theoretically stay short longer than you can stay solvent. Fighting the Fed and the bullion banks simultaneously is not a fair fight. Fifth, sentiment is damaged. Retail investors who bought at 33 and watched it drop to 30 are demoralized. Some will sell at a loss. Some will swear off silver forever. That reduces future buying pressure. These are real risks. Anyone telling you silver is a guaranteed win isn't being honest with you. This is why I say never invest more than you can afford to lose. Never use leverage on physical precious metals. And always have a plan for both scenarios. But here's why I remain fundamentally bullish despite the short-term manipulation. JP Morgan accumulated over 1 billion ounces of physical silver between 2011 and 2020. They didn't do that because they're bearish on silver. They did it because they know where this is going long-term. They manipulate the paper price down while accumulating physical. When the paper market finally breaks, they'll be positioned to benefit from the physical price explosion. We should be doing the same thing they are, just at a smaller scale. Central banks globally added over 1,000 tons of gold to their reserves last year. China, Russia, India, Poland, Singapore, all buying. They're not buying because they think the dollar is strong. They're buying because they're preparing for a monetary reset. Silver follows gold. It always has. The ratio will normalize eventually, and when it does, silver will outperform dramatically. Industrial demand isn't slowing, it's accelerating. The AI boom requires massive new data centers. Those data centers need silver for connections and thermal management. The military-industrial complex is ramping production of missiles and advanced weapon systems. Silver is in every one of them. The green energy transition, whether you believe in climate change or not, is happening. Solar panels, EVs, battery storage, all require silver. We're going to consume more silver in the next decade than we have in all of human history. Mining supply is constrained by underinvestment. It takes 7 to 10 years to bring a new silver mine online. Silver prices were too low for too long. Nobody invested in exploration. Now we're facing structural deficits with no near-term supply response possible. The BRICS nations are building alternative payment systems that reduce dollar dependency. Russia and China are settling trade in local currencies backed by gold. A commodity-backed currency system inherently supports higher precious metals prices. The de-dollarization trend is real and accelerating. 3 key takeaways, and we're out. 1. The $2 billion profit from silver's crash went to the same concentrated shorts that have been suppressing this market for decades. The margin hikes were the mechanism. The banks that hold the shorts have influence over margin policy. This isn't random market movement. It's engineered wealth transfer from weak hands to strong hands. 2. Physical and paper markets are diverging in ways that cannot continue indefinitely. Physical demand is surging while paper prices crash. Premiums hold while spot drops. Inventory drains while prices fall. This divergence is the tension that eventually breaks the paper market's credibility. 3. The bearish case is real and deserves respect, but the bullish fundamentals haven't changed. Deficits continue. Industrial demand grows. Central banks accumulate. Mining supply stagnates. The shorts are playing a short-term game. The fundamentals are playing a long-term game. Time is on the side of physical holders. The unresolved tension is this: how long can the paper tail wag the physical dog? How many more margin hikes before the market loses faith in COMEX pricing? And when that day comes, will you be positioned to benefit, or will you be the one they profited from? As I said in the previous video, accumulate on weakness if you have the conviction and the capital. Don't try to time the exact bottom. Don't use leverage. Don't invest your rent money. Build your position like you're building a foundation, brick by brick, regardless of short-term noise. Do your own due diligence. Understand the risks. Be accountable for your own decisions. I don't sell signals. I don't offer mentorships. I don't have a course. This is free analysis from someone who's been watching this market longer than most of these YouTube channels have existed. Invest with logic, not hype. VIP out.